All right, everybody. Thank you so much for joining us this evening. I'm hoping to share some really valuable information with you about, a little bit about my investing journey, but more importantly, trying to help everyone understand why investing in real estate is really critical to building wealth and building preparing for retirement and why I think it's actually far and away the best possible investment vehicle once all things are considered. So hopefully I will bring you along to that line of thinking here by the end of our thing. I promise that we will be done well under an hour. I don't definitely hate long meetings. Everyone who knows me knows this. So we will definitely be done well before 6:30. Probably be done, between 6 and 6:15. And then if people have additional questions, I'm happy to stay on and answer any questions that you might have. I have muted everyone for now just to prevent any background noise, but towards the end, if you have any questions, feel free to unmute yourself or also post a question in the chat, and I will do my best to monitor the chat as well. So a little bit about me and why you might want to listen to me. So first of all, I am a family man, father of 7 kids, and I've been in real estate for 12 years. And how come, I'm sorry, I just want to get back to my list of participants so that I can mute the new people joining. Here we are. Okay. There we go. All right. I've been in real estate for about 12 years, over 10 years as a real estate investor. Currently, my wife and I own 12 doors that produce us around $6,000 a month in cash flow. Well over $1 million in equity. But I think that the more exciting part about that is that a lot of what we own, we accumulated, a lot of what we own, we accumulated in the past 2 years with, some extreme focus and some luck. So, just want to kind of go through that with you a little bit today. So, I want to start with a question that I think is on a lot of people's minds, and that is, how much money, have you figured out your number, right? How much do you feel like you're going to need to retire? And if so, have you put together a plan to get there? So I want to just share some ballpark numbers with you. Everyone's retirement number is going to be very different, but just for the sake of helping you understand the math here, I'm going to kind of use a generic example. So let's pretend that you have 20 years before you are wanting to retire. And let's just say, to make, again, for the sake of math, that you have a goal of $1 million. Now, with inflation at 1,000,000% and everything that we're dealing with right now, I don't know, $1 million might be low. It's low for me, I can tell you that, but I don't want to speak for all of you guys. But let's just say that you've got 20 years, you're starting with 0, and you need to get to $1 million. The ways that you could get there. So number one, you could stuff it under your mattress, right? I mean, in other words, you could just save the money and not have any rate of return. And in order to do that, you would need to save $4,166 per month without fail. And I think that most of us can probably agree that that's not, I don't know, at least for me anyway, that's a huge amount of money to be saving every single month without, while also covering our other living expenses. Now, you could also put it into a standard yield, just standard, bank savings account, which currently average a 0.06% rate of return, in which case you would need to save $4,142 per month. So by putting it in a savings account, it saves you $20 a month. That's still not very achievable as far as, most people on a standard income, as far as getting to $1 million. And keep in mind, if your goal is $2 million or whatever, I mean, these numbers would be twice that, or maybe you don't have 20 years. If you put the money into a mutual fund that yields, maybe a 7% return, you would need to be saving $1,959 a month. If you put it into something that's going to yield you a 10% return, such as maybe like an S&P 500 type index fund that typically averages around 10%, you would need $1,381 per month. Now, in real estate, very conservatively at 12%, and you'll understand the math on that later, but with the multiple revenue streams that you get from real estate between appreciation, cash flow, debt leverage, tax savings, etc., 12% is ridiculously low. I mean, you would have to do very poorly on investing in real estate and still get a 12% return in the long run. And if you did that, you would only need $1,087 a month. In other words, a fourth of what you would need if all you were doing is saving it. So getting a good rate of return is really, really essential towards building wealth. I think everyone already knows that, but I just wanted you to see how dramatic this example is. Now, I've gotten a list from, and this list was developed by Gary Keller, and it's a list of all the amazing benefits of real estate. And this is where I'm kind of getting the inspiration for our content tonight. So number one, real estate is accessible. Anyone can buy property. We live in the US, not in feudal England. Number two, real estate is appreciable. In almost all cases, real estate goes up over time. Now, I know you might be thinking, well, there's the dips, right? I mean, there's definitely times when real estate doesn't go up, but in the long run, and I'm going to show you some graphs on this later, real estate always goes up over time. Number three, it's leverageable. Because real estate is a fixed hard asset, you can borrow against it. Now, yes, you can, use leverage with stocks and other things as well, but it's significantly riskier. Banks are willing to lend money on real estate for relatively lower down payments and significantly lower interest rates because there's a significant and extremely valuable collateral in the fact that they, the real estate itself, they could foreclose against it and take it back from you if you didn't make your payments. And the leverage of real estate is incredibly important. It is rentable. People will pay the owner to use the property, and you can actually create positive cash flow on properties that even that are mortgaged. And oftentimes, again, going back to stocks or mutual funds, typically not rentable. You might get a dividend, but not rentable. It is improvable. You can add value to a property by improving it. It is deductible, depreciable, and deferrable. And if you're not really great at tax stuff, you might have no idea what I'm talking about with those, but we're actually going to spend a couple of minutes on those topics later on, and I'll explain what each of those means. It's very stable. Real estate values are not as volatile as the stock market. Yes, real estate values can go up and down, but not by, significant margins on a daily basis like stocks can. And most importantly, it's livable. People have to live somewhere. And I've got a quote. You notice the bottom of all my slides, I have these quotes at the bottom of each slide. And I'm probably not going to, spend a lot of time talking about, the quotes, but I do have a quote later on one of these slides that says that, it was a quote from Oprah who's saying that she would invest in real estate over stocks because you can't live in a stock certificate. So I just got to know that someone said they're having trouble accessing the meeting, but I don't know. I've been admitting all the participants. There's not any unadmitted participants. So anyway, hopefully people are able to get in. All right, now I want to run you through two different scenarios, and I'm going to show you the math on how I came up with these numbers here in a minute. But let's just say that you had $60,000 and you decided to invest it in the S&P 500 with an annual return of 10%. How much do you think you would have in 30 years? Without using a calculator and without any of the math experts, I just want you to like take a stab and post in the chat what you think you would end up with. And if people on my team who have already seen this, you're not allowed to answer. But other people who are just guessing, let me know. 60,000. Start with 60,000. You're not going to add any more money at all. You're starting with $60,000 and you're just going to let it sit there. 10% returns for the next 30 years. How much do you think you would have at the end of 30 years? So far, I'm not getting any answers. And is everyone afraid to answer? All right, I got one answer. Somebody came in with 180,000. So $60,000, 10% return. I got two people at 180,000. Wow, that's interesting. Two people with the exact same number. You guys aren't allowed to have the exact same number. Oh, dang it. I accidentally clicked on the screen and showed the answer. Oh, sorry. Hold on. I got a couple people who I need to mute here. Give me just 1 second. Okay, so the answer is $1,151,661. So it's a lot. You start with 60,000, don't put any more money in, just get a 10% return, wait 30 years, you're going to end up with $1,151,661. Now, let's just say that you put the same $60,000 into real estate, but instead of buying a $60,000 house, if by the way, if you know of anywhere I can buy a livable, rentable, cash flowing $60,000 house, I'd love to hear about it. But let's assume that you use your $60,000 as a 20% down payment on a $300,000 house. How much will you have in 30 years, combining all the cash flow that you're going to get on it over the course of 30 years and combining your equity gains? Just one house in 30 years. And go ahead and post your post your answers in the chat. I don't know if I'm just not seeing the chat the right way or if everyone is afraid to answer. All right. Well, I guess I'll just have to tell you the answer because I'm not getting any answers. But the answer is probably going to blow your mind. And don't worry, I'm going to show you how I came to this number here in a minute. Oh, we got a new chat one right here. No answers yet. It actually comes out to $1,917,000. Now I know that number, when I ran it myself, I was like, holy cow, how can that possibly be true? All right. Well, let me share with you my sources for this data. So first of all, Fred, let me expand my screen here real quick. You know what? I'm not sure. Can you guys see on my page this Fred economic search page that I just pulled up? Yes, you can see it. Okay, good. All right, good. You can see Fred. All right, so this is from I forget what Fred stands for, but it's some sort of Federal Reserve economic data agency that puts together interesting economic data. And they have a chart on here that goes all the way back to 1963. Okay, so the average price of a home in 1963, this is national, of course. The national price for a home in quarter one of 1963 is $17,800 compared to, we only have quarter four of 2021. They haven't posted quarter one of 2022 yet. $408,100. So if you do the math on that, it comes out to a gain of about 5.5%, about 5.5% per year. So if you think real estate is, really expensive right now, and obviously you can see the spike that we have right here recently, it is a little expensive right now. But either way, people in 1963 probably thought real estate was expensive then as well. But with the inflation, and with constantly rising real estate prices, and you can see in the long run, yep, here was our big dip that we saw in 2009. But in the long run, we've seen an average prices increase by 5.5% per year. Now, I think it's pretty safe to say that if we've been experiencing 5.5% per year since 1963, that it's relatively safe to assume that trend should continue. Certainly there will be ups and certainly there will be downs, but when I'm projecting the value of my investments in the future, I'm using a 5%. Hey, let's be a little conservative. Let's not assume 5.5%. Let's assume 5%. Okay. So I created a spreadsheet here, and I'm sorry if you don't like spreadsheets, and this spreadsheet here totally overwhelms you, but I'm going to try to explain it to you. So let's just assume you buy a $300,000 house and you put $60,000 down, just like the example that I gave you before. So that means you mortgaged $240,000. I'm estimating that your rent on that property is $20,400 a year, which I think comes out to, what was it, $1,700 or $1,800 a month, which is pretty reasonable for a $300,000 home in a decent cash flowing area in our market right now. Your estimated mortgage payment comes out to $16,670 a year. For your expenses, I'm using 8% for a property manager, 5% vacancy, and 5% management. So you can see in this example, I basically have no cash flow left over. So by the time you pay the mortgage, and by the time you pay, for your estimated expenses, you're going to be left with $58 for the whole year, which you didn't really hit a home run on that investment. Ideally, most of what I've invested in, we've generated significantly positive cash flow from day one. Okay. But let's just pretend that you don't hit a home run, right? Because not every investment you're going to do is going to be a home run, right? Let's just assume that all you did was you made $58 for that year. Okay. Well, where it starts to get exciting is even just 1 year later, the value of the property, as you can see with my formula here, I've got it going up by 5%. So the value of the property is now going to be $315,000, right? And also your mortgage balance got paid down by $4,000 using someone else's money, right? And the rent. So average rents, sorry, let me go back to my spreadsheet here. I'm in my slideshow here. Since 1980, now I couldn't find any data farther back than 1980, but since 1980, average rents have increased by 8.86% per year. And sorry, I am just not good at pulling up my participants panel here. I was going to try to mute. I don't know. My control panel keeps disappearing when I share my screen, and I don't know how to fix it. So I apologize. If you guys could just mute yourselves, please. Anyway, so average rents have increased by 8.86% per year. For the sake of this example, I'm just using that the rent is going to go up by 5% a year. So I'm literally just taking the rent that we got in 2022 and assuming that it goes up by 5% in 2023. Okay. With inflation at, whatever astronomically horrible number it's at right now, that's actually an extremely conservative number. All right. And so your cash flow in year two becomes $794. Still not amazing cash flow, but because of the gains that you had in your equity, you gained $15,000 in equity, and your mortgage got paid down by almost $4,000 using someone else's money. You actually got a 33% return on your cash in the second year, the $60,000 that you put into it. And anyway, I just continue that for 30 years. I mean, again, if home prices have gone up by 5.5% since 1963, I think it's safe to assume that trend will continue. So you buy a $300,000 house today, 30 years from now, it'll be worth $1.3 million. But the more exciting part is, so that, and of course the mortgage will now be paid off, but the rents also increasing at 5% a year. You're now getting, where's my rent? $88,000 a year in rent. And I know, when I see that number, you're probably thinking, holy cow, there's no way, how will anyone ever be able to afford that much rent? But I promise you, if you went back to someone from 1963 and said, would you believe that in 2022, people are going to be paying $3,000 a month in rent and people are going to be buying $500,000 houses like it's nothing? I'm not like it's nothing, but you know what I mean, right? So so that's just the nature of real estate. Over a long period of time, it goes up, significantly. All right. Now, of course, I've already mentioned inflation several times. Inflation hit 7% in December, fastest pace since 1982, 40-year high. It's kind of a buzzword. I think everyone, it seemed like before the whole Will Smith thing at the Oscars, that's all anyone was talking about, right? And now all anyone is talking about is the Will Smith thing. But before that, it was inflation and gas prices and all of that stuff. So real estate is a perfect hedge against inflation. Real estate virtually always at least matches, but usually exceeds the rate of inflation. And this is, a look at inflation over the decades compared to real estate values. Of course, 2021 being a dramatic example, inflation at nearly 7% and home price appreciation being at 18%. 2020 was a pretty dramatic example as well. But it really, even if you look back over the last 50 years, real estate values, other than the 2000s, where real estate values only went up 2.3% compared to inflation at 2.6%. But the reality is that probably by the end of the 2000s was 2009, the real estate market was really, really down at that point. And so it was just sort of a bad time to make that measurement. All right, now I want to jump into some of the tax benefits of real estate, and I'm going to spend a little bit more time here because I think it's something that a lot of people really either take for granted or don't fully understand. So the first part, you probably, especially if you own a home, you probably do understand that real estate is deductible. Your property taxes, your property insurance, your mortgage interest, which is a huge one, of course, if you have a mortgage on a property, your property management fees, your costs of maintenance and repairs, and all those different things, advertising, office spaces, all that stuff that you pay for in relation to owning and managing real estate is all deductible. So in other words, you get to deduct all these expenses and you're really only having to pay taxes on your actual profits. So let's just say that you rented out a property and you made $20,000 worth of rent in a year. Well, by the time you deduct your taxes and your insurance and your mortgage interest and your property management fees and all the different things that you had to pay in relation to the property, you certainly didn't make $20,000. So it wouldn't be fair for the IRS to tax you on that money. So maybe you're left over with $5,000 as an example. Well, the IRS will take that $5,000 now and tax that as income, except for the next most awesome category, and that is that did I skip a slide? No, deductible. All right, so that is that real estate is depreciable, and this is something that I didn't really, and again, I'm not an accountant, so certainly you can consult with an accountant, but this is the general explanation of kind of depreciation on real estate and how it works. So if you're a business and you, I don't know, let's just say that you sell coffee, right? And you have to buy espresso machines or whatever. Well, the value of that machine, it's not going to last forever, right? It's going to wear out over time. So the IRS lets you depreciate it over a period of time so that by the time it wears out, you can, you've kind of gotten the money back from that in tax savings and you can replace it. But with real estate, they let you depreciate it over 27 and a half years. But the interesting thing about real estate is that it doesn't really wear out in 27 and a half years. I mean, I'm sure many of you have owned or lived in or rented, or at a minimum, you've seen homes that are significantly older than 27 and a half years. I mean, there's, homes that have been well maintained that are way over 100 years old. So let's just use our $300,000 property example. Okay. You can't depreciate the land because land doesn't wear out over time. So let's just say you bought a $300,000 house, but the actual structure, let's say the land is valued at $30,000 and the structure is valued at $270,000. If you take the standard depreciation on that, it would result in a $9,817 depreciation deduction, which most likely would wipe out any of the additional profits that you had on the property. So going back to our deductible, we talked about, okay, you're renting a property for $20,000, but after all your expenses, you made $5,000 in profits. Well, after you depreciate the property, you get to take an additional $9,817 in depreciation, which basically in the IRS's eyes means that you made no money. You actually had a loss on the property. So you made no money, which means that $5,000 that you got in profits is tax-free. Now, again, you might say, okay, but I've got to maintain the property. Well, no, your maintenance of the property is already, cost to maintain and repair the building, that's already deductible. You already deducted that. And then you also get to take the depreciation. And of course, the house is not going to be worn out in 27 and a half years. Now, there is a downside to depreciation, and that is capital gains. So when you take an investment of any kind, Bitcoin or I think even art or almost anything, right? When you invest your money in something and you sell it in the future for more money than you bought it, then the IRS wants to charge you capital gains tax on that. And the capital gains tax is, different depending on how long you've owned the asset and how much money you make and a couple different factors. But for most people, your capital gains tax, as long as you've owned the asset for longer than a year, is somewhere between 15 and 20% of your gain. So let's say you bought a $300,000 house and in the future you sold it for $400,000, removing all the other variables of, real estate fees and maintenance that you put into the property. Let's just pretend, a perfect $100,000 gain. Then the IRS is most likely going to charge you somewhere between $15,000 and $20,000 in taxes on that gain. But real estate has one of the most beautiful loopholes that exists in the tax code for being able to avoid capital gains tax. And that is that the capital gains tax is deferrable. You can do this thing that's called a 1031 exchange on real estate. So when you own an investment property, in order to avoid paying capital gains tax on that property when you sell it, you can do a 1031 exchange, which has some rules. You've got to take all the money from that property and you've got to buy a new property. And the new property also has to be an investment property. And the new property that you buy has to be more expensive than the property, or it has to at least match the value of the property that you sold. So if you sold your $400,000 property, you can now use that to go out and buy a new, I don't know, maybe you decided you wanted to buy a $600,000 property. You've got a ton of equity in there. You can get a bigger loan. And so you get a more expensive property. Or maybe you decide to sell your $400,000 property and you go out and buy two $300,000 properties and you pay no capital gains tax on the sale. There's some complications with the 1031 exchange. There's a very specific way that it has to be handled. And we've done some 1031 exchanges and we can help you if that's something that you're looking to explore. Let's talk about it. But I don't want to go too deep into the weeds of exactly, how long the timelines and, how fast you have to buy the new property, but there's some restrictions, but it's not overly difficult. They give you plenty of time to sell the old property and rebuy the new properties as long as you're not dilly-dallying. So you got this $100,000 gain, you put it into a new property and you pay no capital gains tax. Now, when you depreciate an asset, it does make so when you buy this house and you're depreciating it over the 27 and a half years, if you want to just sell it and take the cash, it is going to increase the amount of capital gains tax that you're going to have to pay when you go to sell it. But ideally, the most ideal scenario is that you don't Here's the Oprah quote I was talking to you all about earlier. I'll forever believe that buying a home is a great investment. Why? Because you can't live in a stock certificate or a mutual fund. So anyway, that's probably my favorite quote in the whole presentation. But anyway, getting back to the capital gains tax and the 1031 exchange. Eventually, when you pass, you can actually pass the property on to your heirs. And when they inherit the property, they will receive a step up in the cost basis to the current value. Okay, so if you can get by without selling the property and just keep it forever, eventually pass it on to whoever you want to inherit it, they'll inherit it at the current value. Then they could choose to sell it, and they're basically not going to pay any capital gains tax on it, because they inherited it at its current value. Does that make sense? Hopefully that makes sense, because it's a really powerful part of real estate, and all this depreciable and deductible and deferrable is basically why really rich people, like Donald Trump, for example, don't pay very much in taxes, because they are able to significantly deduct and depreciate their real estate holdings, and they don't sell them because they don't want to pay capital gains tax. And if they really need to sell them, they do a 1031 exchange, or if they really want to sell them, they do a 1031 exchange. Now, let's just say you're older and you're just sick of managing properties and you just want out and you want the cash. Yeah, you're gonna, if you sell it, you're gonna have to pay capital gains tax, but obviously it'll be worth a lot more, and you might be willing to bite that bullet. But more, what I would try to convince you of doing is keep the property, do a cash out refi if you really need the cash, right? Pull some cash out of it, lower your cash flow, but at least you'll get a lump sum of money that you'll be able to, live on and enjoy. Hire someone else to manage it, so you're not involved with it at all, and you're just collecting the rent checks every single month. And then pass it on to your kids, highly leveraged. Or you could be nice and pass it on to them free and clear. Now, one of the biggest objections that I get to people who want to invest in real estate, but they're just, their biggest challenge, what they really can't conquer, is the down payment, right? So to buy investment real estate, you're going to need usually 20% down, sometimes 25% down, especially if it's a multifamily project like a duplex, triplex, or fourplex. And that's a lot of money to come up with for almost anybody. And so one of the best ways to start building your real estate portfolio is by doing what's called house hacking. And maybe you've heard this phrase. It's I didn't invent it, but pretty commonly used. And it talks about how you can actually buy a primary residence, right, and live in it for a while, and then eventually decide that you don't want to live in that house anymore. And instead of selling it, you turn it into a rental. And then you buy your new house with, again, a minimum down payment, because when you buy your primary residence, you might only need 3 or 5% down, or if you're a veteran or willing to buy in rural areas, you might be able to buy your new house for no money down. Okay, here's why that's really powerful. Number one, your cash on cash return will be significantly better when you house hack, because you have very little money in the asset, right? Very little money that you've actually used to acquire it. But number two, when you're financing an owner-occupied property, you get a better interest rate than an investor, even if that investor is putting 20% down, which is just mind-blowing to me, that a buyer can buy their primary residence with 3% down. And the bank is willing to give you a better interest rate than an investor who's going to buy it with 20, even 25, or even 30% down. The owner-occupied buyer still gets a better rate. I mean, obviously they've done their math and feel that owner-occupied is lower risk. So that's one thing to consider. Could you house hack? Could you take your current residence and turn it into a rental? If you don't currently own a home, could you buy a home in the future that it might not be your dream home, right? It might not be Instagram worthy. It might not have all the beautiful upgrades and things that you want, but man, it'd make a great cash flowing rental. You buy that, live in it for, however long it is, a year or 6 months. There's no actual minimum time frame. And then you turn it into a rental, and go buy another house with a minimum down payment. Another possibility would, if you own your home, would be to possibly do a cash out refinance on your primary residence in order to tap into the equity of your home. Now, you probably heard interest rates have risen quite a lot recently, and so if you have an unbelievable rate in the twos or even in the low threes, I probably don't want you to go out and do a cash out refinance. But my wife and I, we were lucky enough that when rates hit rock, super low into the twos, we did do a cash out refinance, and we were able to get some cash that we used to purchase several investment properties. And those, it made our monthly payment go up by about $200 a month. But those 3 investment properties we bought with the money give us around $2,000 a month in cash flow. So, and they're going up in value significantly and building significant wealth. So I don't think that's always right, but when rates are really good, or, there might be, and when you got a ton of equity in your home, there could be some options to do that. And then another possible option that you could explore is, another possible option that you could explore is that you could, depending on your retirement account, you might be able to invest inside of a self-directed IRA. You can actually own real estate inside of a self-directed IRA. So if you have enough in there where you could buy real estate inside of that, you can get it done. There's the downside to buying inside of an IRA is that it's very difficult to finance. It's possible, but you're going to need at least 35% down, and it's not going to be super great rates. So if you're going to invest inside of an IRA, most people that I've talked to have said, you know what, I would only do it if I had enough in my IRA to buy the house completely free and clear. Probably not worth trying to mess with the loan all inside of the IRA. So what I look for in terms of investment properties. So number one, I just want to point out that a good interest rate makes, I think a lot of people think, well, I can't invest in real estate unless I'm able to find the deal of a century. And really, I think that when you can get a home for a great interest rate, that actually makes up for, it not necessarily being the deal of the century. I'm not saying I want you to go out and overpay, but, getting a good house and just sometimes just taking action, get a good house at a decent price and making sure that the numbers on it make sense. You don't necessarily need to get a house for 80% of the, current market value or anything like that. I personally only invest in properties that will have positive cash flow from day one. I do kind of hear some chatter from a lot of investors who are like, well, I'm really in it for the equity gains, and I don't really care about, well, let's back up there for a second. Equity has made me a lot more money than cash flow, right? But that's just because we're in an insanely hot market, right? That might not always last. And so I've always figured, you know what, as long as the house is producing positive cash flow for me, I care, but I don't really care if the on paper value goes up or down. Does it really matter what your current Zestimate is if you're not selling? Right? Does it really matter what your current house is worth on paper if you're not thinking about selling it? Something's only worth what it's worth when you go to sell, right? So I want to make sure I've got positive cash flow so that in a downturn in the market, I know that, regardless of my equity position, I'm still generating positive cash flow every single month. I like to buy in markets that are growing, attracting jobs and increasing in population and desirability. The reason I bring that up is because you don't want to be only focused on cash flow. You can probably get, incredible cash flow in some, ghost town, right? But you're going to have a hard time. The value of that property isn't going to go up significantly over time, and rents might be decreasing over time. You might be dealing with vacancy. There's a lot more to consider besides just positive cash flow. I do want it in a good area that's growing and that shows a lot of promise. And for the house itself, and this could differ by market, but in the Phoenix area, I like to look for homes that have 3 to 4 bedrooms, 2 bathrooms, 2-car garage, single level. So that part's important to me. I do own 1 2-story property, but everything else is a single level. And that's just because they appeal to a larger audience, multi-generation, people, elderly parents, or disabled, or all sorts of different people, or are not able to live in a 2-story, but everyone can live in a single story, right? So it's got a larger audience and is more desirable by most people. So I like to mostly invest in single story homes. But here's the kicker. I want the house to be small. Okay. I have talked to several investors who are like, well, gosh, this house is only 1,300 square feet. And I just feel like people are going to want more than that. Yeah, I'm sure there's an audience of people out there looking for, larger homes. But for me, when I have to turn it over, if the house is going to need paint, or if it's going to need carpet, or if it's going to need stuff like that, a 2,000 square foot house is going to be a lot more expensive to turn over in between tenants than a 1,300 square foot house. I definitely want low or no HOA at all. With durable finishes, I don't want a lot of carpet. That's a big one. Like, I don't want carpet in all the living rooms and stuff. Mostly like hard, tile or luxury vinyl plank type flooring. I'm not a huge fan of like wood or, something that I think is going to get damaged over time. I want mostly desert landscaping. Granite countertops. Black appliances are actually my first choice over stainless steel, because the stainless steel is going to scratch and dent more easily. Just little things like that to think of. And lately, what I've been referring most of the investors we work with is newer construction, brand new construction even. There's some really good value with brand new construction lately. And there's some downsides, particularly right now with our interest rate climate. I don't know if I'm in love with buying a new build and waiting 6 months for it, having no idea what the interest rate is going to be 6 months from now. So there's some things to consider. But either way, even if I'm buying an older house, I want to make sure that it's got at least a newer roof and AC units. Because if you end up buying an investment property and you have to replace the roof on it within a year or 2 years or 5 years, it's going to pretty much wipe out all of your cash flow for a long time. And that's going to suck. So what I avoid in investment properties. I don't like to invest in homes with pools unless, sorry, I should clarify. That's for a long-term rental, right? All of ours are long-term rentals. If I was going to buy a vacation rental in Scottsdale, then I would definitely want it to have a pool. All right. But for long-term rentals, I don't like a pool, A, because of, liability concerns. B, I don't know if I would trust the tenants to maintain the pool. So I would feel like I need to pay for the maintenance and make sure that it gets maintained. There's going to be extra costs associated with, oh my gosh, the pump needs to be replaced and the gaskets need to be replaced. Just all the things that come up on pools. And that's going to eat into my cash flow. I'm sure you'll be able to rent the home for more money though, if it had a pool. Solar panels is a big one. When you buy a house with solar panels, that's going to be an extra expense for you. Whether even if the solar panels are free and clear, you're paying more for the house because it has solar panels on it. Or worse is if the solar panels have a loan or a lease that you're inheriting. I know the math on it. It's you would think, okay, I should be able to go to these tenants and say, hey, this home has solar panels and I'm generating. You're not going to have a power bill, and that's going to save you $200 a month in rent. So I'm charging $200 a month more in rent than the guys down the street. But I don't know. People's minds just don't work that way a lot of the time, and a lot of tenants are just looking for. They're searching on Zillow or what other website they're using for homes, and they see the one down the street's $200 a month less. They barely even pay attention to the fact that yours has solar. They're looking for the best value. They see that one and they jump on it. So not a fan of solar. If the home backs up to a busy road or power lines, I'm not like dead set against busy roads or power lines, but just know that someday when you go to sell that property, you're going to have to sell it for a little less money because it backs up to a busy road or power lines. And so make sure that you're buying it at a discount, because someday you're going to have to sell it at a discount. Expensive HOAs. I already mentioned this already, but most of the tenants, they're usually looking for the most affordable home that has all the criteria that they need, not necessarily the home that has all the best community amenities. So very expensive HOAs, particularly like condos and townhomes, they're more likely to raise their HOAs significantly as the market goes up as well. And that can really hurt the cash flow. Our best cash flowing properties do not have an HOA. And then I'll just say this. I'm not opposed to investing in super established, highly sought after neighborhoods with A+ school and no crime and all that stuff. But I can tell you that in our market, I mean, I can't speak for the rest of the country, but right now you will not be able to buy a house in Gilbert with positive cash flow with a low down payment. Now, if you want to put 50% down and own a house in Gilbert or Chandler or whatever, then that's great. But for the most part, those properties are not producing positive cash flow. So just keep in mind that you're probably not living in the house. It's more about the math than it is about what you personally love or want in the house. So how should you get started if you want to at least begin exploring investing in real estate? Number one, I'd love to invite you to meet with the agent who invited you to our webinar here first. And then a couple of the things I definitely would recommend if you're not familiar with Dave Ramsey, a big Dave Ramsey fan when it comes to getting out of debt and I'm not, I'll be honest, like I'm not a huge Dave Ramsey fan when it comes to the wealth building part of it, but the getting out of debt stuff, I think he's a genius. So, before investing in real estate, you should definitely have an emergency fund set up. And in my opinion, you should have all credit card debt at a minimum paid, and car debt would be ideal as well. It's really hard to build wealth when you're paying significant interest to other people, right? What's the point of buying real estate that's going to give you a 12% return and then you're paying 29% interest on a credit card, right? It just doesn't make much sense. If you're in debt and it feels hard and you don't know how to get started, check out Dave Ramsey. He's got a fantastic YouTube show and podcast, and or even just on his website, he's got this fantastic thing called the debt snowball approach that we used that worked really well for us. Now, if you don't currently own your own home, that is absolutely where I would start, is that you should buy your own house. But I think the biggest mistake that I see most people making is that they want their first house to be, I'm just using this as a dramatic example, but they want it to be Instagram worthy, and they want it to be, have all the pretty, the current classic, what everyone loves, not everyone, but what most people, they want the white kitchen and the gray tones and the quartz countertops and the, be willing to sacrifice a little bit what you want, knowing that this isn't your forever home, right? Buy a house that would be a good rental property, live in it for a while, and then eventually turn it into a rental property. I don't know if you know this, most people don't, but you can actually buy multifamily property as a primary residence up to a fourplex. So let's just say, for example, that there was a duplex or a triplex out there somewhere that you were willing to live in. You, as long as one part of it is vacant and you can move in and live in that unit, you can actually buy it as your primary residence, rent out the other side, and create, oftentimes, especially if it was maybe not a duplex, but a triplex or a fourplex in this market, oftentimes the rents from the other units will completely pay the mortgage, and you'll be basically living there for free. Save up some more money to go buy the next property and turn that one unit into another rental. Now, one downside to that, and I like to mention this to everybody, there's not really any like triplexes and fourplexes in the Phoenix area that I'm aware of that are in really nice, beautiful neighborhoods with manicured lawns and so they're not always in the nicest neighborhoods that I've seen so far. But if you see one, you might want to jump on it. And if you're willing to live in not so nice a neighborhood to start building your portfolio, if I was single and I didn't have kids and I didn't have all that stuff, I would go live in one of those properties so that I could start acquiring more properties faster. It is all, of course, a possibility to turn your primary residence into a rental. We've already kind of touched on that, but make sure when you do that, that you that you change your insurance policy. Make sure that your insurance company knows that you're turning it into a rental, and be careful on the loan. I'm not advocating. I know I've got a good friend, Jeff Locke's on here tonight. He's probably like, oh my gosh, I'm not advocating that you commit loan fraud here. You cannot buy an investment property and tell the lender that it's your primary residence. Okay, you can't go out and buy a primary residence and with never intending to live in it. Okay, it needs to actually be your primary residence if you're buying it as your primary residence. But you don't have to stay there forever. You do not have to stay there forever. You can buy a primary residence, live in it for a year or two, turn it into a rental, and go buy another one. All right, and so that's it. I know that there are a couple of questions that got posted in the chat. So let me just see here. So yeah, some people were talking about how much of your rental income can you use. So a lender will use, when they're trying to determine how much you qualify for, they're going to use what's called your debt to income ratio. How much money do you make compared to how much money are your debts? And when you start to own real estate, they're going to look at your tax return and look at how much money you actually made on your investment properties according to your taxes. But they can add depreciation back in. So if you depreciated property, they can add that back in. So the depreciation does not hurt you in terms of what you could qualify for on your next property. If the property, if you have a rental that's not on your taxes yet, then typically they'll let you use 75% of that to offset the debt. So let's just say that you've got a property it's renting out for $2,000 a month. The lender will let you say $750. Excuse me. What did I say? It rents for $2,000 a month, $1,500 a month. They can count as income that will now be able to be used to offset your debt. So let's say the mortgage, you're renting out a property for $2,000 a month. The mortgage payment on it is $1,400 a month. You now have positive cash flow according to the lender of $100 a month. Another person asked, who is my ideal tenant not violating fair housing laws? So thank you for that. Yes, of course, no discrimination against any protected classes, race, religion, sex, familial status, sexual preference, all of that stuff. But here's what I look for in terms of an ideal tenant. Number one, their income needs to be at least 3 times the rent. Number two, I would prefer them to have a relatively stable job history. It's a red flag to me when they have changed jobs too frequently recently. Number three, I prefer tenants who are going to stay in the property for more than a year. I am not a fan of renting to people who are like, oh, we're getting ready to build a home, or we're going to buy a home, but we just want to get to know the area a little bit better. And a year from now, we're just going to be here for a year. I've even had people offer to pay the entire year worth of the lease up front, but basically made it clear that they're not staying beyond the year. I would rather rent to someone else who's not paying it all up front. Well, I didn't want all the rent up front anyway because of tax reasons and too much income all in one year. But B, I really like tenants who, man, we were in our last property for 8 years and now our landlord is selling and we didn't want to move, but we have to move. Oh my gosh, that's the perfect tenant. But with that in mind, I don't really want, it's a line, right? You always got to review all the applications that you get and choose the best one. But ideally, I'm often not looking for a tenant with a 720 credit score. I don't necessarily want them in the low 500s or 400s. Like, it's a balance, right? If they have a 720 credit score and amazing income and incredible job history, there's a really good chance that they're going to go buy a house, right? So I'm looking for someone who's more on the cusp in terms of their credit score. Somebody else asked about investing in state versus out of state. So far, Christy and I, we own one investment property in New Mexico, and that was when we house hacked. It used to be our primary residence, and we've kept it all these years, and I'm sure glad that we did, because it is worth way more money now than what we bought it at 12 years ago. And we've just kept it. But other than that, everything else we own is local. I prefer everything to be local because I'm a bit of a control freak and I like to know the numbers, and I run the comps on all my properties, and I update my little net worth spreadsheet, and I don't want to have to rely on someone else to I don't know. I guess I just haven't found another agent who has impressed me enough with why I ought to invest in their market yet. I'm not saying I wouldn't consider it, but I need to find the perfect agent to do that with. If you know me at all, I'm a huge stat rat. I study the real estate market every single day. I look every single day at, and maybe you've even seen a few episodes of my show that I do every couple of weeks about the market update and that kind of thing. And so far, I haven't had another agent who blew me away with their statistical market knowledge. And I want to have a high degree of confidence that when I'm investing in property, that I feel like the value is going to go up. And so far, everything that we've bought, of course, I mean, honestly, you could have bought a manufactured home on leased land, and it still has gone up in value over the last couple of years. That's how crazy the market is. Property managers, it depends on your preference. Most of our properties, someone asked if I use a property manager. Most of our properties are not professionally managed. I manage them myself. It's a bigger conversation. It depends on how, I'll say this. Managing properties is not as hard as you have built up in your head that it is. And it's not just constant calls of toilets and tenants and termites. And, most of my tenants almost never bother me with anything, and they pay their rent on time. And it literally only takes, I mean, with all 12 of our doors, it really only takes me a couple of maybe, I don't know, 3 or 4 hours a month is what I'm spending on all of our properties. Property managers, charge a lot in fees, and unless something goes wrong, they don't really do a lot in return. And I would love to encourage you guys, if you're thinking about it, at least have a conversation with me, and I'll show you exactly how I've automated some of the stuff, and whether or not you whether or not you should use a property manager. Somebody else asked, and how are we doing? 6:27. I got 3 minutes. Okay. Somebody else asked about the Airbnb. So Airbnb properties, if you buy a property and you want to turn it into a vacation rental, that can absolutely work and can create even better cash flow than long-term rentals, but it also requires significantly more work. You've got to furnish it. You've got to do a lot more maintenance. You're turning over tenants every single, couple of days. You're cleaning, and, to me, I wanted mailbox money, so it wasn't the right fit for me. But there's another complication to Airbnbs, and that is that if you want to go, let's say you buy an Airbnb and you start renting it out and you're getting positive cash flow, and now you want to go buy another property, the lender isn't going to let you use that Airbnb income unless you have set it up as an LLC with separate bank account, and you have got at least 1 full year of tax returns proving how much money that Airbnb is making. And so it's very difficult to use Airbnb income to help you qualify for a new property. On VA, I got another question about VA, whether or not you can have a VA loan on a primary residence and later turn it into a rental property. I am 99% sure. I don't know if Jeff Locks is still on, but I'm 99% sure that you can do that. You can take a VA loan. Again, I believe you do need to live in it for at least a year or something like that, but you can buy a home using a VA loan, no money down, and turn it into a rental property later. Yes. And thank you. Jeff Locks just answered that. Yes, you can use a VA loan and then rent it out later. The VA, there is a complication on your eligibility and using the VA loan the next time, and possibly higher funding fees, and talk to a lender. There's some things to consider as far as, can you use your VA loan again? And yeah, your eligibility and how much you can qualify for on the next loan could be tricky. But you can actually have multiple VA loans. I've had a lot of veterans think, oh, well, you can only have one VA loan at a time. I know that's not true, but it depends on how much your loan balances are and your eligibility amount and a bunch of crazy factors that I don't know how to calculate. And then, yes, I will be uploading this to YouTube, and I will share it with you if you registered for the class using our Eventbrite link. I've got your email address, so we'll get this. It'll take a while to upload, so I won't be able to get it out until tomorrow. But yes, we will get this out to everyone if you'd like a copy of it. Thank you guys so much for attending. If you have any additional questions, please feel free to reach out, email me, call me, text me, smoke signal, or the agent who invited you here. They can absolutely help you out with this information as well. Thank you guys so much for your time, and have a great night.